Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to a brand new week. This is Peter Lewis with Money Talk on Monday the 15th of May. Just a reminder that we're on iTunes, Spotify and Google Podcasts. If you go to my website, peterlewismoneytalk.substack.com, you'll find all the links to your favourite podcast apps there. The programme also has a Facebook page, Peter Lewis Money Talk, and I'm on Twitter at MoneyTalkR3. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, US Treasury Secretary Janet Yellen said Friday that the federal government will have to renege on some payments if Congress doesn't raise the debt limit, and soon. Though any plan on how the department would proceed with an unprecedented default has yet to be presented to President Joe Biden. Ms. Yellen said if Congress fails to do that, it really impairs our credit rating and we will have to default on some obligations, whether it's treasuries or payments to Social Security recipients. President Biden's nominee to serve as the next Vice Chair of the Federal Reserve, Philip Jefferson, described progress on core inflation as discouraging. He noted the uneven progress, with much of the deceleration occurring in food and energy prices and not enough progress in other categories. But he said the full effects of our rapid tightening are still ahead of us because of the delayed impact of Fed rate increases in slowing down the economy. Finance leaders of the G7 rich nations warned of heightening global economic uncertainty on Saturday. G7 central bank chiefs pledged to counter elevated inflation and ensure expectations on future price moves remained well anchored. They also offered more money for Ukraine, agreed to set up a new supply chain initiative, and vowed to fill regulatory gaps in the banking sector. The Hong Kong government announced on Friday that the SAR's economy grew 2.7% year-on-year in the first quarter of 2023, recovering from a downwardly revised 4.1% contraction in the previous quarter, and confirming preliminary estimates. That ends 4 consecutive quarters of contraction and springs the local economy out of recession, supported by a strong recovery in inbound tourism and domestic demand. On today's programme, I'm joined by Alex Wong, Director at Alex Wong Asset Management, and John Schofield, Managing Director of Tempus Investment. And with a view from mainland China is Brock Silvers, CIO at Kaiyuan Capital.
Peter Lewis's Money Talk.
In the markets, the S&P 500 posted a second straight weekly loss as regional bank concerns lingered and survey data showed rising consumer inflation expectations. The S&P 500 slipped 0.2%, closing at 4,124. It was down 0.3% for the week. The Dow dropped 9 points. That's under 0.1% to close at 33,301, taking its losses for the week to 1.1%. The Nasdaq Composite fell 0.4%, ending the day at 12,285. And the index gained 0.4% over the week. Regional banks continue to decline after Los Angeles-based PacWest revealed Thursday it lost almost 10% of its deposits in the first week of May. Shares of PacWest fell 3% Friday, taking its losses since the beginning of March to almost 84%. PNC fell 1% and Zions Bank Corporation closed 1.1% lower. Hong Kong stocks dropped for the 4th straight day. The Hang Seng Index fell 117 points, or 0.6%, to 19,627. For the week, the city's benchmark was 2.1% lower. The Tech Index was 0.5% lower over the week. In mainland China, the Shanghai Composite fell 1.1% and closed at 3,272, dragged lower by education services stocks, and for the week it was down 1.9%. Futures markets are forecasting a decline of 0.9% for the Hang Seng at the open. That's around 185 points. And elsewhere in the markets, Treasury yields were higher. Fed Fund futures markets are pricing in 16% odds of another 25 basis point rate hike in June, compared with an under 10% chance earlier last week. The 10-year Treasury yield climbed 8 basis points to 3.46%, and the US dollar index surged to the highest level of the month, and oil prices fell for the 4th consecutive week. You can get more details on the latest market movements in my daily newsletter, which you'll find at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
Let's welcome our guests. We have with us Alex Wong, Director of Alex Wong Asset Management, our regular Monday commentator. Morning, Alex.
Good morning, Peter.
And also with us is John Schofield, who is Managing Director of Tempus Investment. Very good morning to you, John.
Yes, hello, good morning, Peter.
Let's start by looking ahead to some key economic data that's coming out of the mainland, due for release tomorrow. Expected to suggest the mainland's recovery is on track because of base effects largely. Official figures on Tuesday are expected to show rapid year-on-year growth in industrial output and retail sales for April, with both of those key data sets likely accelerating from March. Fixed asset investment in April is also projected to have gathered pace. However, the data does compare to a period a year ago when the manufacturing and finance hub Shanghai was locked down because of spreading COVID cases, and restrictions on movement slowed or halted activity elsewhere in the country. So, Alex, it's going to be rather difficult to compare, isn't it? But what are you expecting from the data to tell us about the mainland economy?
I think, of course, it's difficult to compare because the base is low. But I think people reckon the manufacturing sector in China will still be not as good as expected. And the local sales or the retail consumption probably would be okay. So this is still the story in China right now.
It's an uneven recovery, isn't it, really, driven by the service sector. And we seem to be seeing that in US companies, those in the services sector are reporting, they seem to be reporting that demand is returning. Is that correct? Is that where we're seeing the growth?
Yeah, right. Right now, it's this kind of recovery. We are seeing demand for services, but the manufacturing sector actually are still quite slow.
John, what are you expecting to see from the data?
Yes, I mean manufacturing output is quite strong, but at ever decreasing prices. We saw last week the PPI negative, so there's still deflation is coming out of China in the manufacturing sector. I think we also see that in the falling prices in the inputs, whether it's oil prices and all the base metals are declining in quite sharp downtrends currently. So there's deflation coming out of China. So these figures this week will probably, as you say, be marginally on the disappointing side.
The recovery probably, is it fair to say, it hasn't been as swift or dramatic as people have been expecting?
Yes, there was an assumption there was going to be a huge bounce back to normal when China reopened. We did see a bounce, but it certainly seems to be running out of momentum now.
Where do we stand on the travel sector? Do you think we heard a lot of stories about a big boost to travel over the holiday week that we had recently? Is it back to pre-pandemic levels, or do you think we've still got a long way to go?
It is, I think, already approaching the pandemic level. I think travel actually is very welcome. But I think the way Chinese traveling actually has changed a lot. They actually, their behavior is based on very popular app suggestions. So they are going to a few places and using low cost. So I think even we are seeing strong turnout of tourists, but the overall spending actually has changed, and that I think is a point to note, because many Thai tourists actually spend less than before, because they probably would not sleep in luxury hotel or even hotels. They just sleep in restaurant, and then they spend less on food. They just go for some very cheap but hygienical food. So I think this is a change of behavior in Chinese tourists.
And what's driving that change? Is it that because they're worried about their jobs, or they're just becoming more price conscious post-pandemic, where they realise they've also got to spend money on other things like healthcare, for example?
No, I think they want to look good on social media.
Oh, really?
That's a major change. Yeah.
Okay.
Because you look smart when you spend so little, and then you you do have some good photos on the social media.
It seems to be reflected by what we're hearing in Hong Kong, that people that hoteliers are saying that people are coming from the mainland, but they're just not staying very long, and they don't seem to be spending much money.
Yeah, right. Actually, I think later on probably we'll see them sleeping in McDonald's.
John, what does this mean then for the recovery, the consumer recovery sort of going forward? But presumably it's not going to be as strong as people were hoping.
Yes, well, there's obviously capacity constraints still. Airfares are very, very, very elevated. As we've seen from Cathay's comments last week, they don't expect to be able to get back to capacity until late next year, and airfares are going to stay high. So I think people are being selective. They've got to allocate more of their holiday budget to the travel aspect rather than the spending on the ground. But we've all noticed how destinations like Japan have become extremely popular for Hong Kong people. So that's going on, but the incoming inbound tourism is still very muted. I think people, maybe passing through on their way to elsewhere, which was always a traditional practice anyway. But staying less. They might have stayed 3 or 4 days and caught up with friends and things, but now they're probably just maybe staying one night or something like that.
So this means then that over the summer, those firms that are sort of basing their outlooks and their forecasts on sort of a big sort of surge, if you like, in revenge spending over the summer, they're likely to be disappointed.
Well, it's going to be outbound, I think, or the majority of it will be outbound rather than incoming. We may see more incoming, seasonally, I think Hong Kong is a much more popular destination as we get into the autumn and past the typhoon season. So we may see people coming back and travelling.
Alex, what about the restaurant sector? Companies like Starbucks, they're reporting a pickup in the first quarter. Yum China as well. We seem to be seeing this reflected. What's happening in China reflected more and more in the quarterly reports that we're getting out of US companies. Includes Disney as well, doesn't it? What's the outlook for those companies, do you think?
I think not that good. I think because Chinese F&B sector is super competitive. So they are facing very tough domestic competitions now. So I think looking ahead, this is a very tough market to beat.
And what about things like the resorts, the casinos in Macau? Do you think what's the outlook for those types of companies as the economy sort of rebounds?
They are still okay, but I think it is very difficult to go back to their peak level because for Macau, there would be no VIP business, and we are not. We should not expect this to be covered by tourists. I think because we are not talking about a single batch of 1 million or so. We are talking about probably 500, 1,000. And this is very difficult to make up the VIP market.
John, I suppose the other thing that's going to be important in this data is what it tells us about the global economy, the outlook for things like exports, for example. What are you expecting there?
Yes, I mean the import and export figures last month were very poor, as we were discussing. So, I don't see a lot of growth in exports.
I mean, we had a big sharp decline in imports, didn't we? Which sort of rather suggests that domestic demand in the mainland isn't particularly strong.
Yes, I mean, sectors like the luxury goods coming from Europe have been very strong recently. We've seen record prices for some of those French LVMH and so on,
and Richemont as well.
But you have to wonder whether that's we're at the peak of that particular phenomenon.
It is amazing, isn't it? I mean, Richemont, I think they, which owns Cartier, Van Cleef & Arpels, they reported record first quarter profits, partly based on this recovery in China.
Yes, indeed, and that may have been revenge spending.
Alex, tell me a bit about Hong Kong's economy. We had the data on Friday confirm the preliminary estimates of 2.7% year-on-year growth. The previous quarter was revised down to a 4.1% contraction. So we've seen a big turnaround here in Hong Kong. But once again, a large part of that must be the base effect, mustn't it? Because we're comparing to 1 year ago when things were pretty grim in Hong Kong.
Yeah, I think we probably need to see whether Hong Kong could benefit more from Chinese tourist revival. That I think should be still optimistic. But as I said, the overall spending may be less, or per head spending probably will be less. But I think that is picking up at least in tourist number, and that would be helping. But the finance sector actually is quite dull right now. So we do not have much large IPO coming to Hong Kong, and also I think the corporate sector actually is also quite dull. So probably we would be more dependent on the tourist sector right now.
And the government, it's predicted 3.5% to 5.5% growth for this year. On Friday, they said now they expect growth to be at the higher end of that forecast range. Are you as optimistic as the government?
I'm not that optimistic, actually. I think this is affected by the slowdown in other pillars in Hong Kong economy.
John, what are your thoughts about Hong Kong?
Yes, I mean, hopefully things will stabilise, but I don't see anything like a boom. In fact, there's a danger the growth might start to tail off soon with, all kinds of global factors like the high interest rates and so on, and inflation. So yes, I think that's. I think we'll be lucky to see, say, 4%.
How much of a difference do you think things like the consumption vouchers, these happy Hong Kong events are making to the economy? Are they boosting private consumption?
Yes, clearly that's a good thing. It helps to cheer people up a bit as well. So, but yeah, I imagine the July disbursement will be the last one. So these kind of one-off stimuluses are not going to be present later in the year, which is why I think we could well see things tailing off a bit.
So the government's really got to come up with some new ways, then, hasn't it, of looking for economic growth rather than relying on these sweeteners like consumption vouchers and so on that we get in the budget every year. They've really got to think more long term.
Yes, well, so far we seem to be adopting the mainland model of build infrastructure. I mean, everywhere you go now, you see some sort of construction activity all over, and of course we've got these mega projects in the pipeline, including the whatever it's called now, the Lantau artificial islands, East Lantau artificial islands. So a lot of spending is going to be going into infrastructure, but where that leaves the man in the street on consumption and so on is remains to be seen.
Alex, I want to switch attention back to the mainland again, and this crackdown on mainland consultancy firms that we're seeing at the moment. We saw the raid on Capvision. We've had Bain & Company. Another US firm, Mintz, was raided in Beijing, and local employees detained there. What is behind this? What's the concern? Because this has all come a bit out of the blue, hasn't it? We've seen a crackdown on the tech sector, on the education sector, but what is the concern about these consultancy firms?
I think this, first of all, this is affecting the perceptions of the U.S.-China relationship because they probably are targeting on the foreigners gathering information. So that means people will still view U.S.-China relationship to be bad for quite some time because China actually is taking actions, even though we do have some high-level executives meeting in Vienna between the two countries. But I think people probably would not have much expectations to have some improvement in the relationship between the two countries.
Is this putting off US companies from doing business on the mainland?
Not every sectors, but I think sectors on information gathering, I think that probably would be affected. And even I think accounting probably would have some impact later on.
Even on the accounting sector, what do you mean in terms of firms that analyse the financial reports of state-owned companies? Could that be under scrutiny?
Yeah, right, yeah.
Right. Well, that could apply to a lot of brokerage firms as well and investment banks.
But they try to open the finance sectors to overseas. I think they probably would still try to secure foreign fundings in SOEs. Probably that sector would not be affected that much.
Mm. John, what do you make of this? It's all suddenly sort of come out of the blue, hasn't it? And also, if you look at what these companies are doing, it doesn't look like they're doing anything illegal in the sense that the data that they get is very publicly available. It's all on the internet. It's on financial companies like Wind, but they're very good at bringing all of that together and then making their conclusions. But it sounds like writing about certain topics now is going to be completely off limits.
Yes, I mean, there's been an asymmetry for a long time. Remember, all these growth areas, whether it's AI and other forms of digital activities. I mean, this is the future, so it's very sensitive for both sides. I think the fact that Google and Facebook and so on cannot operate in China is already tells you quite a lot about the asymmetry of the policy. So, to what extent China's sort of trying to have its cake and eat it, if you like, in that respect. Very selective about what areas foreigners can invest in, and only in things that they feel they can control. So, we're seeing the tilt. I think President Xi has sort of reiterated that the growth emphasis is on still the same old infrastructure, investing in manufacturing and so on.
Do you think it'll put off US companies from doing business on the mainland? Are they going to have a rethink?
Well, those who are already in and have substantial businesses with moats like Apple, of course, being very prominent. I'm sure they will continue to run their business as best they can, and for the foreseeable future. But in terms of ploughing in major new investments, I don't see that happening. And certainly portfolio, the very lackluster performance of the stock market here on the mainland just tells you that foreign investors don't have a great deal of confidence in putting money into China.
Well, Alex, let me ask you about that lackluster performance that John just mentioned. We've seen it certainly here in Hong Kong, haven't we, where stocks in so far this year have really underperformed global benchmarks. It also looks like US stocks have run out of steam this quarter as well. They put in a good performance in the first quarter, but pretty well stalled out now in the second quarter.
Yeah, I think the performance in the private company sectors in China actually is super bad. We do have a sell-off in tech, and then that sell-off actually spread to consumption names as well. So I think this is a an exit of foreign investors in everything in private sectors in China right now. And actually, the Hong Kong is supported by probably HSBC and a few SOEs. So that's why we still have the Hang Seng Index to hold above 19,000. Probably we still may still be supported by the strength of these few counters, but the index actually do not reflect the bearishness in private companies, private sectors in companies in China. So the internet and the consumption names actually are very bad right now, and I think we looks like to have a downside break soon this week.
And so does that mean then that investors should be looking at the large state-owned enterprises like the banks, for example? We saw a rebound, didn't we, last week in some of the big banks. Some of them traded limit up in Shanghai for the first time in years.
Banks actually, Chinese banks usually have a short-lived strength because people do not trust their books. So that's why they are so cheap. And whenever they got some banks, actually, the banks actually short-lived. So I think this time probably would be a little bit better. But I doubt whether they could run a very long way because the banks actually are not transparent and also highly geared. And that is the nature of banks in everywhere of the world. For Chinese bank, the good thing is that we don't need to worry about withdrawal of deposits, but we do have a worry about the transparency of the book and also the practice of lending. So I think they will still be at a discount to global peers.
John, would you be a buyer of the banks? They are cheap, aren't they, in the mainland? Traded about 0.6 times book value.
Yes, they're cheap, but they've always been cheap for a very long time for that the kind of reason Alex has mentioned. Yes, that was quite a nasty technical reversal in the banking sector, but also the whole index last week bounced on that sort of piece of apparent good news, bounced strongly on the Monday, but then it gave it all back by Friday. And a little bit more, perhaps. And
presumably, what is behind the bounce? I mean, I've heard several reasons. One is that they are cheap and people are sort of looking at them again. Also, under the sort of like the restructuring, the reforms that are going on under President Xi Jinping in the mainland, he wants banks to take a bigger role in, if you like, promoting new industries, developing the domestic economy. Is that behind it?
I'm not sure exactly, but certainly the market as a whole is sort of very prone to having to apparent good news, having a quick rally in one sector or one company or whatever. It's just a sign of I would say almost desperation of traders and investors trying to find a way of making money out of this what is frankly a bear market.
Alex, then final word to you. What do you put this rally down to that we saw in the financials last week? What's behind it?
First of all, we do have the latest report earnings come out that is a little bit supportive, and then we have the cut in deposit rates and also lending rates simultaneously. So I think people expect the margins to expand a little bit. So I think that is helping the sectors a little bit. And of course, the thing is we do have a run-up in SOEs in every other sectors, and banks actually probably is the last one to go. So I think that is why the technical is helping.
Well, thank you both very much. You heard there Alex Wong, Director of Alex K.Y. Wong Asset Management, John Schofield, who is Managing Director at Tempus Investment.
Money Talk.
I'm joined now by Brock Silvers, who is Chief Investment Officer at Kaiyuan Capital. Morning, Brock.
Good morning. Good to be with you again.
Thank you very much. An important day, isn't it? An important week for Chinese economic data. We've got all the activity data coming out tomorrow, retail sales, fixed asset investments, industrial production. Of course, it's going to be compared with a year ago when we had Shanghai in lockdown, large parts of China also suffering restrictions. So what should we be expecting and how much should we put into this data when we compare it with 1 year ago?
Well, look, I expect the numbers tomorrow to be very positive. As you say, industrial production, retail sales, fixed asset investment, they all should be up very strongly. Now, the government's going to really hike these results, and the local finance sector, which is dependent upon sort of the success of the China story, is going to cheerlead. But last year was catastrophic. The month-to-month data can only look good in comparison as recovery sets in. And I think at this point, the hype has completely overshot the facts.
And we're seeing that in corporate earnings, aren't we? Even in US companies, a lot of them are talking about China in the first quarter, and either they've done better than expected, or in many cases they've been a disappointment. Partly because, as you say, they overestimated the strength of the recovery.
Yeah, that's right. Look, in reality, we're seeing consumer prices that were almost flat last month. New borrowing slumped. The housing market sales have also turned downward again. April trade data, it showed imports down strongly and export growth sort of slowing as global supply chains refill. China's economy is performing okay, but tomorrow we're very likely to be told that it's guns blazing, and it just isn't.
I mean, as you say, when you see that almost zero inflation print and imports collapsing, it's not a very good sign about the strength of the domestic economy, is it, going forward from here?
I would even say deflation is a worry, and we may likely see a small PBOC rate cut in the near future.
Oh, really? How is it that China is escaping the inflation that's really infecting pretty well the rest of the world, maybe with the exception of Japan, but even there it's climbing, isn't it, now?
Yeah, look, some of it is simply good work. Some of it is a bit of luck in the cycle. China also had lower lows than most as well.
So what's the consumer like? How strong is consumer spending? What sort of state is the consumer in? We were hearing earlier on today on the program that the consumer really is sort of looking for bargains, not spending a lot of money at the moment when they travel and go out and eat.
Well, a couple of months ago, we were being told that to expect a consumer explosion that was going to save everyone and lift all boats, and that certainly has not happened. We are not seeing that sort of consumer rebound. We are seeing some, but as you say, the consumers in China are also being quite prudent, and savings are also up. In a broader sense, the economy has some real risks on the horizon. The upcoming dollar bond maturity schedule is absolutely untenable, and nothing has been done so far to resolve that sector. LGFV finances are, generally speaking, a total mess. And let's not forget, U.S.-China relations are probably at a 50-year low. So I would think put all that together, and it says that investors have to tread lightly and take the coming pronouncements, which are undoubtedly going to be positive, with a huge grain of salt.
And also credit growth is slowing as well now, isn't it? We saw that in the April figures, although March was a bumper month for credit expansion. So what does that mean for the policymakers? Does that mean they've got to really try and turn on the spigots a bit to boost the economy?
I think they do. I don't think they want to just yet, but ultimately I don't think they'll have a lot of options. They're just going to have to do something. And, the overwhelming priority of the administration is to keep the economy moving forward, and they need that not just for economic reasons, but for political ones as well.
Let me turn to another issue on the mainland, this crackdown on consultancy firms like Bain & Company, Capvision, Mintz was another one that got raided in Beijing. Why is this going on? What are the Chinese authorities concerned about here?
Well, look, this is a very unfortunate situation, I think. China needs Western capital, and many Chinese securities, I think, deserve that Western capital. But this administration just has other priorities, and they are willing to restrict the flow of basic info for their, in order to meet those larger goals. Now, we see this everywhere now. Still inadequate audit standards were sort of highlighted this last week. Bond pricing, fee disruption. Now standard kind of due diligence activities are brought into legal question. All of this is going to have an impact. It clearly these clearly are connected results of some strategy decisions. What we can see, though, is that it is having an impact. Many investors and funds are reducing or even eliminating China allocations. And look, without access to basic corporate and economic data, it's not investing, it's gambling.
So it sounds like from what you're saying, regardless of how these companies get their information, even if they get that information perfectly legally using open source data on the internet, using financial firms like Wind, despite that, there are certain topics that they basically are not going to be allowed to write about, and they will be crossing the red lines. Is that right?
Well, it's worse than that, because you don't know in advance where those landmines are and what those acceptable and unacceptable topics might be. Mm. So you might think that you're doing something acceptable today, only tomorrow to find out that it was not acceptable, and now you're in hot water. And a lot of companies and investors, allocators, decision makers are just not going to want to play by those rules.
So what does it mean then for investment banks? Let's suppose, for example, you want to do some due diligence into the financials of some of the big state-owned banks. I mean, that's a big issue, isn't it? And banks have been in focus last week. Does that mean that you could get in trouble for doing that?
You could. It's I think intentionally unclear in this regard. And what that means is that you can't fully do the same level of due diligence that you were doing before, which even then was probably not as much as you would have preferred. Mm. And what that means is that a lot of bets will simply not be placed.
So what, is this putting companies off going to China and opening businesses in China and investing in China, and particularly US companies? Is it putting them off? We saw this report about Forrester Research, a US tech-focused research group, says it's going to plan to cut the majority of its China analysts now following this.
Yeah, look, I think it definitely will. Normally if you were an allocator or a CEO who had some China plans, those plans in the abstract may have been entirely worthy. But if you're thinking about some more remote province, you would generally hire a firm to help you to understand the local layout and some of the risks involved. And now you simply can't do that. Mm. You can't walk into a CapVision, Bain, Mintz, and say, I need some help for this investment project, and I need to understand the following areas. Mm. They're likely to not be able to do that right now. And if I can't get that information, I can't make a decision that I'm willing to kind of bet my career on.
So is China open for business? The leadership, the Politburo, the Premier say, look, we want foreign capital. We want foreign firms to come here. We want American firms to come here. That's what they say publicly. But then you see things like this, which rather goes against that, doesn't it?
That's right. Look, just to be clear, there are lots of opportunities in China and companies in China that I think are worth investment and worth owning. However, I think China is going to soon be forced into a real decision. Does it want or need Western capital or not? Mm. And what we're seeing now is sort of the dance of saying very loudly, yes, we do, but acting like the answer is a no. Mm.
So this is yet another sector then that's come under scrutiny. We were hoping that this crackdown on various sectors that we've seen on things like the technology sector, on the education, the private education sector, which had a huge impact on those the companies there. This is going to be another area now.
It's another significant question mark, and again, I just think that there's a large subset of investment decision makers who are going to say, I can't play that game. Mm-hmm.
So tell me a bit about the markets then. What's the market on the mainland? It seems to have stalled out. It certainly has here in Hong Kong, hasn't it? It's really not been a particularly good year for Chinese companies listed in Hong Kong.
That's right. And look, I think we will eventually see brighter days, but it wouldn't surprise me if it didn't happen this year. So, I just think there are too many gray areas that still need to be sorted out, from some of the larger regulatory issues we've been discussing, but also just some of the economic things. We need to see China on a more solid economic footing. We need to see some resolution to the U.S.-Sino relationship, and we need some comfort from the Chinese administration that foreign investment is still a welcome participant in the process.
So you wouldn't invest in Chinese stocks either here in Hong Kong or on the mainland for at least the rest of this year?
Yeah, I think right now I would be extremely prudent with Chinese equities, and it's more on the investability issue than it is on the economic cycle issue.
Well, Brock, thank you very much. It's very interesting to hear your thoughts on that. That's Brock Silvers, who is Chief Investment Officer at Kaiyuan Capital. Thank you for listening to Money Talk this morning. You can find more details about some of the topics I've been talking about today, along with information on the other headlines and market moves on my daily blog. Take a look at peterlewismoneytalk.substack.com. I'll be back with another show tomorrow. Joining me then will be Asian fund management industry consultant Stuart Aldcroft, Andrew Sullivan, founder of Asian Market Sense, and joining me from the USA will be Tony Nash, founder, CEO and chief economist at Complete Intelligence. Have a great day.
Money Talk